Good afternoon, everybody. This is Todd Zempel and Joe Gordon with another edition of the Gordon Asset Management Podcast. Today is October 13th, right around noon. So as we go through all the information today, keep that in mind. Of course, make sure to like and subscribe to our podcast. You can also view this live on the YouTube machine. So go to YouTube and just search Gordon Asset Management. You can find our content there. So first off, let's cover the coronavirus update. U.S. COVID cases climbed quite a bit week over week by about 630,000 to about 7.77 million cases currently. Hospitalizations are also up big, so almost 5,000 week over week. If you remember last week's presentation, hospitalizations were only up about 500 people, so just fractionally. So that was a big jump week over week. Deaths are also up about 4,800 week over week to about 207,000 combined. Now, before we hopped on the podcast today, Joe, you were actually mentioning some pretty interesting comments about COVID and some of the work that's been done out there.
Yeah, so actually I saw a 32-minute video interview this morning, and I had seen the name of this before, but hadn't had the time. It's circulating now all over the internet, called the Barrington Declaration. So what was interesting is these three healthcare professionals, two epidemiologists, one from Harvard, one from University of Oxford, and then also a physician and public health care specialist with an emphasis on infectious disease from Stanford. The three were being interviewed, and it was quite enlightening that they were looking at the non-political solution to addressing COVID. They didn't want anything to do with politics, and they think the whole thing's been politicized all over the media in the U.S., if not the world. So interestingly, I went on the CDC website today and even saw the World Health Organization now are saying, don't shut down, don't shut down. So again, not getting political, but they're saying that's the wrong strategy. And the conclusion, and there's more than one conclusion, but one of the takeaways I got from the report was these three healthcare professionals said that, in essence, herd immunity is not a strategy. Herd immunity is the ultimate byproduct of what your strategy is. And they cited Sweden as a great example of doing it the right way, with the exception is they did not protect the elderly in Stockholm initially. That's why they had the massive death spike. But by and large, they've done it right with everyone else in their society, and they addressed the protecting the elderly part, and you could see that there's hardly any deaths they've had at all the last 3 months. In fact, Z over here went and Googled some stuff in Sweden, and it looked like pre-COVID, people are out in the restaurants, no one's wearing masks, everything seems pretty normal, and so forth. But one key takeaway also from the Barrington Declaration is that it's been signed, I believe, by 5,500 physicians and over 11,000 healthcare professionals. That ought to speak volumes about people that know and ought to know at ground zero.
That's right. And so we also have this week, Trump apparently no longer infectious with his COVID that he had.
Yeah, last night he said he was so healthy he was going to kiss everybody in the crowd. That's a scary thought.
That is a very scary thought. All right, so we'll move right on to the market recap. So internationally, well, actually across the board, things were pretty good. We need some we're in the money little bumper music as we talk about.
Yeah, we really do.
But EFI was up 1.73%, still down just under 6% year to date. Emerging markets was a big winner, up 4% plus, and moved into the positive, up 2% year to date. And then the global aggregate bond index was up fractionally, 42 basis points, currently up about 6% year to date. What's interesting to note about the emerging markets index, and so for the folks that are viewing this on YouTube or live via the webinar, you can see the slide that we have up in front of us, but there's been a massive move in the makeup of the index, more towards consumer discretionary and technology. So the chart that we have in front of us shows that currently the emerging markets index is roughly made up 50%, 51 to be exact, of consumer discretionary and tech, while energy and materials have scaled back since the roughly 2010. I think the peak was in 2008 or 2009. And so that's just interesting to keep in mind. We like emerging markets, e-commerce as a trend. It's a big growth area, but it is making up more and more of the index overall.
Yeah, one of our favorite themes has been playing an ETF for the last 4 to 5 years that is a play on 85% of the world's population that lives in emerging markets. And most of these folks don't have checking accounts. Most live in countries without sound banking systems where you can actually lose your money literally. There is no FDIC. And essentially, COVID has accelerated the use of e-commerce and all forms of mobile payments and everything. And obviously, in the stay-at-home economy, you got consumer discretionary spending is up big as well. So we do have some other active managers that actually, and that they're primarily emerging or global, and they have allocated significantly to e-commerce. Some are up over 50% year to date. So the trend is real. All that's happened with COVID is it has pulled forward the transition to a digital economy and e-commerce especially. I believe I heard a data point yesterday that even Amazon's e-commerce sales are up over twice as much as what's projected pre-COVID.
That's right. And so the trend is your friend until it's not, anyways.
So here's an interesting slide we're looking at is what recap in the U.S. markets last week. I mean, if you'd have asked me March the 24th, that we would be sitting here on October the 13th and the S&P 500 would be up 9.01% year to date when its peak to trough loss was down 33, I would have said you're crazy. It just doesn't happen, but it did. And that's what happened last week as the S&P marched up 3.68%. For those watching the markets yesterday, it looked like giddy times with the mega techs. Apple was up over 6% yesterday, and the other mega techs pretty much towed in line. NASDAQ was over 5% last week and week over week last week, and now it's up over 38% year to date, which is amazing. But the real story is finally there may be a secular bull underway, and I think a lot of it's the GDP reports that are coming out for Q2 and now Q3 projections. As small stocks, Russell 2000, up over 4% last week on top of almost 4% the prior week. And now their year-to-date return is minus 1.16. And so that is telling us there's an emergence of a trend that the small caps are finally starting to move. And that is a sign that potentially we have a secular bull market underway. And again, bonds are pretty much at zero rate. Interest rates are up 6.55% year to date, a little bit uptick last week, but that's all a function really of the fact that it's price appreciation and the return year to date. So we look at equal weighted versus cap weighted, but the big thing on the chart I'm looking at is that the Russell 2000% change month to date, now we're talking in October, is up over 9%. Far in advance of all the other indexes. The NASDAQ 100 equal weighted is up just under 6%. The S&P 500 equal weighted is up over 5%. The S&P regular is over 5%. The equal weighted is up 5.74. And that was a trend that began all of September. And then you've got the NASDAQ 100 market cap weighted index, and it's up 5.87. So essentially, all the standard indexes, S&P and NASDAQ equal weighted or market cap weighted, are up between 5 and 6% month to date, but Russell's way ahead by 50% at 9.38%.
Yeah, and so this is that breadth that we've been looking for and have been hoping for, to be quite honest. When you look at the Russell 2000 index, a major cohort of that index is financials, banks. What we started to see today with JP Morgan and them releasing quarter-end earnings is that the loan loss reserves hadn't been tapped as much as everybody was anticipating. So people think that we may start to see this turnaround in financials, which have been lagging year to date. So that could be a little bit of the reason why the Russell 2 has rallied month to date.
And with zero bound interest rates, many companies that have access to the public markets have refinanced a lot of debt at significantly lower rates. So we'll see. The liquidity's been there. It's been provided by the Fed, and it's liquidity that's basically propped up the markets, either fixed income or stocks, all year long. And it is assumed by most everyone, all the talking heads on CNBC and Fox Business, that the second stimulus will happen, if not before the election, soon thereafter, and will prop it up again. So we'll see.
Now again, we need that music. We're in the money for the FAANG Plus Index.
I didn't know you could sing.
Absolutely.
So really, we've already kind of covered this, but we're looking at now FAANG stocks, the mega techs versus the rest of the market. So week over week, as we already said, S&P up 3.68. But then you look at the others, and this doesn't include the big move yesterday. Apple up 6.78% last week, Microsoft over 5%, Amazon 7.62%, Facebook 4%, and then Google 5.51%. Google was a huge mover yesterday as well. Alibaba, which is spinning off Ant Financial, its payments company, up 6.7% last week. Baidu, the internet engine in China, 2.42%. NVIDIA, which is acquiring ARM Holdings for about $40 billion, up 4.28%, and it's already hit its projected stock price from 30 days ago. It was topping $560 a share yesterday. Tesla up 3.9%, and then Twitter up just under 2%.
The employment news. So good news is continuing claims for unemployment fell by 970,000, so just under 1 million week over week. So we currently have about just under 11 million people continuing claims for unemployment. The negative news, initial claims did climb a little bit, climbed by 3,000 week over week to we're averaging around 940,000 initial claims. Then you look at the unemployment rate, we're sitting at about 7.9%. So given that we were nearing 15% back in May, we've clawed back quite a bit. And you look at the 7.9% unemployment rate, there's a lot of people out there that say, the actual employable population is less than 95%, meaning that we on a standard, normal, good times, we should have somewhere slightly more than 5% unemployed. So we're clawing back, and so that's all very positive. For the YouTube and webinar viewers, we have this very interesting looking chart that shows job seeking and recruitment. Negative news is that we have appeared to stalled out a little bit. A number of new job applications, recruitment, job interviews have bounced back quite a bit off the April-May lows, but we were not seeing any major gains since late June. So that's not the best of news, but it is something we're just going to keep an eye on for now.
And some of this has to do with politics. There's an election coming up in less than a month, and a lot of people are not going to make plans. If you can't see the future very clearly, you don't go out and hire a lot of people at all. And that's what happened in 2009 and 2010 when public companies were accused of using all their earnings for share buybacks. They weren't investing in CapEx, and we were living in QE1, QE2, QE infinity, and QE forever. So again, you can't blame CEOs. Share buybacks have really cut back. So obviously they're sitting on their thumbs wondering, okay, well, where's the second stimulus? Oh my God, there's an election coming up in less than 30. A lot of volatility there potentially. And so it's no surprise to us that job applications, recruitment, and interviews has flatlined since June.
Yeah, and another big reason for that is small businesses. So the number of small businesses open charted are down about 24% from January 1st of this year. So small businesses have been hit hard. And again, to Joe's point, it's, a lot of these folks are small business owners. There's uncertainty about what potentially business owners' tax situation may look going forward. So hopefully we'll see some pent up demand, and after the election, some of these different metrics will start ticking up. Again, so for the folks that are able to view this, we have a chart that shows about 34% of small business owners couldn't pay October rent. And that's broken down by industry. So the folks that are hit the worst, beauty salons, so roughly 46% of those polled said that they wouldn't be able to meet October rent. Restaurants, 40%, gyms and fitness, 40%, entertainment related, 38%. So again, all these industries that have been particularly hit hard by COVID, and many of them small businesses, mainly small businesses, are just extremely hurt right now and in a really bad place.
You have to consider also some public companies, not small businesses, but are totally revamping their entire business plan. Give you an example, Disney. They're accelerating their transition in their whole business plan away from parks, since they're all closed permanently right now, which is a lot of the unemployed, to streaming. And again, that indirectly can be a major hit on movie theaters, because there's no content that's been produced much, if at all, for movie theaters. And a lot of the publicly traded movie theater chains are running out of cash. I heard one today is going to be out of cash on December 31st. So there are going to be casualties here that are not small businesses. And then a lot of companies like Disney are pivoting on a dime and going straight to streaming for basically the nucleus of their future business plan.
And now everybody's most hated topic, the election. So there's been an interesting study done that shows the number of voters who say it really matters who wins the presidency. And so this metric has been charted back to 2000, and we're at all-time highs. So around 83% of all the folks polled said that the presidential election really matters. And then the number of people that says, well, regardless of which party or who gets elected, things will be pretty much the same, is at a low, around 16%. So folks are very passionate about it. This is one of those topics that's very hard to talk about with family and friends. It usually causes fights.
Going back to 2000, that's the last time we had somewhat of a contested election in Florida, in particular, where the presidency was decided, I think, by 507 votes in favor of George W. Bush over Gore. And back then, 50% of the voters said it mattered who's president versus the 83% today. And 42 or so percent said it didn't really matter. It'd be pretty much the same back then, and only 16. So that's really the delta, and with the way people are viewing this is really what's noticeable. That's a huge change from 2000 ago, where half said it really matters. Now 83% say it really matters. And then you've got the same inverse data point on those that'll say things will stay the same, only 16%.
Now, does it matter who actually wins? So there's Capital Group, American Funds, put out a very interesting white paper on this, and they looked at during 20 of the last 23 presidential elections since 1936. What they found is that if the S&P 500 index was up in the 3 months prior to the election, the incumbent party usually wins. And then if markets are down in that same 3-month period, the opposing party typically wins. So when we look at the chart of the S&P over the last 3 months, we're up 8% in the last 3 months. So, the polls are saying that it's going to be a Biden win, but the polls also look eerily similar to what they did when Hillary was running.
That's true, but this time may be different. They say the 4 worst words in investing is "this time it's different." That quote was made famous by Sir John Templeton, but actually this time that could be the case, and the reason is the risk of a contested election. One of our favorite economists we follow daily in his missives, David Rosenberg. You can go to Rosenberg's website and see for yourself and subscribe. Basically went through how a contested election would work last week, and it's fascinating because I had no idea it could be that convoluted, and involving 2 of our current amendments and would come into play, et cetera. So So if you have contested market, you really only by law have to have a president at the latest by January 20th, inauguration day. And that's how he kind of mapped how this might all play out. Now, there are obviously other ways it could play out, but the point is none of us have been through a contested election like this. And apparently the only time where it really happened was, I think, in 1830, John Quincy Adams, or some way back in another century, that was decided. So we don't think the market's pricing in that volatility. And again, just to bring up the past, good old Seinfeld, I saw Newman. Newman, you may remember, is the U.S. postal carrier on Seinfeld that had a tendency not to deliver his mail and throw it in his closet. Of course, with all the claims that the Postal Service won't be able to process mail-in ballots, et cetera, Newman did a 2-minute segment that I don't know who paid for it, but it was funny. It was really funny because if you remember Newman, and he did all the normal things he did on a Seinfeld episode, but then in the backdrop while he was talking at the end, 2 guys in black suits came up and removed all the postal machines behind them, taking them away. So it was pretty funny.
Yeah, and so more research from that same American Funds Capital Group report. Basically what they say is no matter who wins, the markets has typically gone up. When we look at a unified government, the average returns in the S&P, again, going back to 1933, have been about 10%. We look at a unified Congress and a president in a different party, annualized returns have been about 7.5%, and then a split Congress, that's tends to be the best situation, and average annualized returns up on average about 10%, 10.5%. So to some degree, as Joe said, things could be different this time. If not, the market will march on. And then last but not least, things we're keeping an eye on.
Well, as we just mentioned, the Barrington Declaration, encourage everyone listening to this to go Google that and read the report or watch the video or both for your own enjoyment. I think it's very enlightening from so many healthcare professionals signing this petition and saying this is the way it should be done. You've got that particular issue, and then you got the election, the Postal Service, mail-in voting. Seems like I'm reading about a scandal every day about somebody committing fraud in this regard, throwing ballots in a river. That is out there. You've got new stimulus efforts. One thing, by the way, this is no formal poll, but and a lot of people I've talked to, they're saying, I'm going to go stand in line to vote. That way I know my vote is real. So there is a lot of people with all the hoopla over potential fraud and mail-in voting thinking, well, my vote's not going to count. I'm not going to even waste my time to do a mail-in ballot. You got new stimulus still out there. What I'm hearing now is that, I think it's pretty much not going to happen prior to the election. It'll happen right after it, probably if Trump wins, and it probably won't happen. Who knows? I mean, who could bet on that now? But for within 30 days, I doubt it's going to happen. They've had every effort to do it. Second wave of layoffs, you got the airlines issues. The more you don't have a second stimulus, the more likely airlines start furloughing employees. And that's why there was this whole thing 2 weeks ago about, well, we'll do a targeted one for airlines. And then everybody said, well, why are they so special? So I think the targeted type things are off. We've got inflation is still benign. There is a potential of some hyperinflation if you print too much money. That's a lot of talk out there. A lot of investors have a lot of cash. There's still huge cash positions sitting and waiting for market pullbacks. And a lot of people are taking any pullback like the September rout in technology to basically buy on the dips. That's still a strategy that seems to be working in this modern monetary theory environment we've been in since 2009. And then you got market breadth. The good thing is you're starting to see others start to move, not just the 5 megatechs. Dollar weakness against the euro, you basically have, the euro they use and will go for negative rates. We've said we won't, but obviously with dollar weakness, you're going to see emerging market equities do better. And as an anecdote, I read in Rosenberg's missive this morning, it was interesting. He focused on Canada, where he's from. And actually, all the GDP numbers in Canada are amazingly positive. They had 380,000 jobs created last month, and essentially most all were full-time. And yes, they are having a real estate bubble up, unlike they've even seen. They thought they'd seen it before in Vancouver and Toronto, but now it seems to be everywhere as millennials especially leave big cities and they're buying used cars because they can't find any new cars because a lot of the factories have been shut down, and they're buying homes with a lot of adequate spacing to spread out and work from home. And then lastly, we've got large growth, rotation, small value. I don't think it's small cap and value rotation. I think small caps, there is a rotation going on, but I still think there's a lot of gas left in the large cap growth because essentially those 5 megatechs, the only one trading at an absurd PE ratio is Amazon, but then they always kind of jerry-rig their numbers depending on their direction. But the other 4 are trading at about 30, 35 times earnings with fortress balance sheets. So you're not really worried there. I mainly worry about the large growth stocks that are trading at 10 to 15 times sales. And you can name one. We all know it's a verb now, Zoom. And so you have those, and if you have a slowdown or something, a jolt, volatility, those are going to really trade down to the low side.
All right, ladies and gentlemen, that's all we had for today. We appreciate you taking a few minutes to join us today and reflect on the markets. If there's anything that we can do for you, please don't hesitate to reach out. You can view our website, wealthqb.com, or shoot us an email at info@wealthqb.com. Thanks a lot and have a great week, everybody.